Why were foreclosures a cause of the Great Recession? Have you ever wondered how a few bad decisions in the housing market could lead to a massive economic downturn? The Great Recession is a prime example of this. One of the main triggers was the wave of foreclosures that swept the nation. Let's break down how this happened and what it meant for the economy. The story begins in the early 2000s when home prices skyrocketed. This surge encouraged banks to offer mortgages to many people, including those who might struggle to pay them back. These risky loans, known as subprime mortgages, often had adjustable interest rates. At first, these loans seemed affordable, but as rates increased, many borrowers found themselves unable to keep up with payments. When home prices began to fall, many homeowners found themselves in a tough spot. They owed more on their mortgages than their homes were worth, a situation known as being underwater. This made selling their homes to pay off loans impossible. As a result, defaults on loans increased, leading to a sharp rise in foreclosures. The impact of these foreclosures was significant. First, they flooded the housing market with homes, which drove prices down even further. This decline in home values reduced the wealth of many homeowners, leading to a loss of consumer confidence. Additionally, many of these mortgages were bundled into complex financial products and sold to banks and investors around the world. When homeowners started defaulting, the value of these securities plummeted. This caused massive losses for financial institutions, which were now exposed to high levels of risk. As banks suffered, they tightened their lending practices. This meant that businesses and consumers found it harder to get loans. With less access to credit, economic activity slowed down. People spent less, and businesses faced challenges, leading to widespread job losses. The foreclosure crisis revealed how risky lending practices could create vulnerabilities in the financial system. It was not just a housing issue. It turned into a full-scale economic crisis. The inability of many borrowers to keep up with their mortgage payments triggered a chain reaction that affected the entire economy. In essence, foreclosures were a major cause of the Great Recession because they highlighted the weaknesses in the housing market and the financial system. The resulting collapse in home values led to financial losses and a significant downturn in economic activity. This event serves as a reminder of the importance of responsible lending and the interconnectedness of the housing market and the economy.